Hello again and welcome. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Today is March 18th of 2021. It's our market outlook and insights update for us. And there's several headlines. Markets are moving, so let's get right to it. And thanks for watching. Here we go again. It's like Groundhog Day, but we're in the middle of March and we're looking forward to March Madness starting tomorrow. With some NCAA college basketball. And it's good to see sort of some norms return to reality, if you will. And that's why we see the 10-year Treasury close to 175 today. And that's really stealing the show, simply because it's seeing and projecting a healthier economy. It's seeing reopening as evidence that tomorrow we're going to have March Madness. We didn't have it last year because of the coronavirus. You add that with the government stimulus, you add that with the Federal Reserve, supportive and accommodative. And Jerome Powell says it's not something not to worry about in terms of in the short term. These little inflation spikes are due to supply chain disruptions. They're bottlenecks that are developing. Why? Because the economy is very complicated. Okay, you can't just flip it off like a light switch and then turn it back on. It takes time. There's going to be some shortages and bottlenecks along the economic cycle of supply chain management. That being said, we're seeing fits and starts all over the place because global demand is coming back from airlines and travel and everything else. Well, the 10-year Treasury now is predicting and projecting a healthier economy. That's why it's rising every day, and it has been the last 6 months. And that's taking off of sort of future earnings, right? So the markets are predicting and projecting future earnings in terms of earnings per share. Well, if you have higher interest rates to high growth companies like NASDAQ, which was down 3% today, it's going to take off some earnings potential. Now, will these companies not earn as much as they have been in the past? Earnings could slow, but I wouldn't bet against it. And here's why. Because we had $1.9 trillion just passed to basically drop that in the hands of the U.S. consumers to be a bridge gap or a stopgap to bridge people back to where they need to be. Now, the Federal Reserve is seeing a taper tantrum, if you will. In 2013, that was a phrase that was coined by Wall Street when, at the time, the Federal Reserve Chairman Ben Bernanke spoke in front of Congress in May 22nd of 2013, and he basically said, listen, we have 7.7% unemployment, we have 1.7% inflation, ex food and energy at that point in time. He goes, we're going to start taking sort of the punch bowl or start winding down their bond purchases, essentially, or being less accommodative, or taking back the QE. That's all the technical jargon to basically say the Federal Reserve is shutting down the party. Well, that's very different. And so as a result, right then and there in 2013, the market sold off dramatically. The NASDAQ, S&P, the Dow, much like what we're seeing today. But it's a very different story, right? We had 7.7% unemployment back then, and the Federal Reserve saying, wait a minute, and coming off the heels of the last recession, we see the economy picking up. So therefore, we're going to start tapering and potentially raising interest rates. Well, the market didn't like that big time. So market sold off significantly back then. But let me take you back to 2013. Guess what? The S&P finished just under around 30% positive for the year. So while you have fits and starts of the bond market, the treasury yields, having a 2-year-old temper tantrum, if you will, markets still can grind higher. What they higher yields are ultimately predicting is a stronger, healthier economy going forward. But back then, the Federal Reserve is taking the medicine away or the punch bowl away from the party. Now, our Federal Reserve Chairman, Jerome Powell, is saying, let's continue to party. We're going to be accommodative. And the market is really testing, ultimately, credibility. So that's the key right here, because we do have 7+% unemployment rate. We do have inflation that's low, but we believe is running hot. So much like back then, the Federal Reserve was pulling back the support. Here today in 2021, the Federal Reserve is being over accommodative and supportive. So that doesn't make sense, right? There's a disconnect that's happening. There's a new 2021 temper tantrum that's playing out. Yields are predicting and forecasting a higher growth for the U.S. economy. And then there's other parts of the economy that are going to take a back seat, like the growth stuff in the NASDAQ that we just saw this last few, year to date. NASDAQ is underperforming relative to the Dow. The Dow has the industrials and the S&P has a lot of the financials and the energy. And financials are continuing to win because if you raise the interest rates, the net margin interest, how banks get paid on your money, basically, and how they're borrowing and how they're making the spread, they automatically have increased earnings, and they don't have to open up one more account or get one more deposit. If interest rates go higher, bank earnings go higher, stock prices for banks go higher, and that's what we're seeing play out right now. Again, I want you to join us next week for Stephanie Link's portfolio. Again, she has nailed this year to date in terms of her portfolio, the way she's balanced, the way she's diversified, and simply because she does have exposure to the banking sector, which is doing stellar year to date. That's why we're looking at in terms of a diversified, balanced portfolio as we do for our clients. So the underperformance last year in your portfolio, they're performing this year, and those that really did well last year, like the technology stuff, it's okay. It's okay for them to take a breather. It's okay for markets to sort of vet their balances and watch the Federal Reserve what they say and watch them what they do, and have markets sort of digest this period in time. Again, history is not going to repeat itself, but it's a wonderful guide. So we don't know how this is going to play out ultimately, but we believe these are all healthy signs. Markets are digesting this. We don't think there's going to be a tremendous spillover effect from higher interest rates from this point forward. We think the 10-year Treasury might test it a little bit more. We'll see how we close this Friday. You always want to watch a Friday close and a Monday open, because that'll let you know if we're going to have continued selling or if there's a bid on Friday afternoon when we close. That means that the market could be done in the correction phases. So we'll see what happens. But for the most part, we love this. We love the volatility of Blanke Schein Wealth Management. That means that we're making great opportunity. We're taking advantage of great opportunities in terms of when things are dislocated or mispriced for our clients, and we're buying high quality stuff, that are on sale. So we take advantage of this right now. But it's always fascinating to watch, and definitely pay attention to what the 10-year Treasury does this week and next week and the weeks to come. So again, that's the recap for today. Thanks for watching, and we will see you again next week. Take care.